Going on, guys? Pillow Trades here. Hey, so I'm happy that this comes up every now and then. All right, so I'm talking about lazy pie, lazy investing. Now, I know how it could be very time consuming, or maybe it could be a little bit intimidating. Maybe you don't understand some of the terms. Maybe you don't understand how things work in the stock market and the economy, and how politics affect it, how this and that, Apple, Amazon, all that crap, Bitcoin. I mean, it doesn't have to be that complicated, all right? But once you get past setting up a brokerage account, it can be easy. The reason why I call this the lazy pie is because it's more of a fire and forget. It's more of a, hey, I don't have time to be looking at the stock market, or I don't know when I should come into this stock or this ETF, or when to, sell. None of that crap, all right? This is a fire and forget, and you will come on top. I am not a financial advisor. You don't need one, all right? You don't need life insurance policies. You don't need none of that crap. You don't need anybody managing your money, your wealth, and, they make a profit out of you. You don't need any of that. Keep all your money, all right? I'm going to show you what I'm talking about. So if you guys don't know, this is my lazy pie. Let me get out the way here real quick. So, hey, so this portfolio, or rather this pie, because remember on M1, they take, they have this pie investing approach where you can set different assets, depending on a criteria, right? So I like to make my lazy pie as lazy as possible. So these are holdings that you don't have to keep looking at them. You don't have to worry about how they perform. They have the history, and they are ETFs, they're broad market ETFs. So you're not at the risk of a single company failing tomorrow, because you never know. Even if some of these companies like Amazon and Apple, they could be too big to fail, but you never know. You really just never know. So this is a little bit more of a sure way, but still having that exposure to the broad market. And as you can see here, we have VO. That is our largest holding in this pie, and that's because that's broad market. Those are S&P 500. Those are the top 500 companies in the United States. S&P stands for Standard & Poor. So this ETF, VOO from Vanguard, it tracks the movement of all of those 500 companies in one ETF. So you don't have to buy a specific stock for each company. You just go into VOO, and you have that exposure. Now, the next one up is one of my favorites. It's called VYM. This is Vanguard's high dividend yielding ETF. So all the holdings in this ETF tend to provide a high dividend. And you guys know that I love dividend investing. It's the reason why I created this channel. Even if you have some overlapping exposure with VOO or VYM, I mean, it's still going to render you those dividends and that growth over the long term. So if you ask me, a lot of that overlapping that comes with having these broad market ETFs, I'm not too worried about it. The more exposure I have, the better. And sure, I don't want to be overlapping too much, but I think this is the perfect setup when it comes to aligning all the stuff you don't want to worry about, but yet you reap the benefits. The next one up is VUG. This is Vanguard's growth ETF. All right, so all the companies here, they're not really focused on paying dividends per se. Some of them might have a small dividend, but they focus on growth. Having exposure to this ETF is going to provide you growth, a little bit more growth than, for example, VYM. VYM is more worried about consistency in the stock's price movement, yet they keep giving you that consistent dividend, right? Even if the holding comes down, so long as that dividend stays put, you should be good to go. VUG, on the other hand, they're not too worried about the dividend of a stock. They're more worried about that growth. So this is where you're going to see a lot of like technology, for example. Technology, a lot of those holdings in that sector, a lot of those companies in that sector are all about growth, right? And not too worried about dividends. Kind of like Tesla, right? Tesla is more about growth rather than dividends. And then the last one is VNQ. Now, this is not, if you ask me, you don't need to put this fourth holding in your lazy pie. The reason why I like to do it is because I love REITs. I love the real estate sector. But that does not mean I like to own real estate. I hear nightmares of people that own real estate, right? Apartment complexes, single family homes, you name it. And Dealing with tenants, I hear that it's a nightmare, right? Even if you have a real estate management property, screw all that, right? You want that exposure without having the hassle to deal with tenants. V&Q is your answer, right? That is Vanguard's real estate ETF. Now, I know real estate is not the hottest right now, but it does have its cycles, right? It can come down, it can go up over the long period of time. But in that long period of time, when you see movement go up and down, if you have exposure to this, especially if it's full of REITs, this ETF can provide all the dividends and the growth that you want in a portfolio. It's not going to be as high growth as VUG, but nonetheless, having exposure to real estate, you're always going to come on top. You will see some downtime on the price movements, but those dividends are going to be coming in, and over the long term, you're going to come on top. Now, I know I went in a tantrum with all these ETFs, or these 4 ETFs that I have in my Lazy Pie, but here it is, year-to-date chart. I am up $6,593.20. I am up since January 2nd of this year, 2024, $1,073.05. Now, my market gain is $9.61.08. My dividends earned are $110.09. When you combine those, you get that total gain for $1,071.17, giving us a rate of return of 20.87%. Now, this portfolio, or this pie rather, only has 4 holdings. The expense ratio is super low, which is, I love it when I see that. It's only 0.05%, but that dividend yield is not the best, it's not the highest, but I guarantee you that this is a great, if not one of the best tools to achieve long-term dividend investing, achieve generational wealth. This is one of the best tools you can have in your portfolio to achieve those goals. That's pretty much it, guys. Thank you for watching. Remember, keep dollar cost averaging, keep investing. Till next one, take care.